Monday, July 7th, 2026. If you were watching the markets, you saw something brutal. The Philadelphia Semiconductor Index, the SOX, the benchmark for chip stocks, plunged nearly 5% in a single day. The Nasdaq 100 got hit for almost 2%. And the real pain wasn't just in the US. Hours earlier in Asia, Korean chip stocks imploded. Samsung, the world's largest memory chip maker, fell as much as 10% at one point. The headline on every financial terminal that morning read something like, Samsung forecasts 19-fold surge in quarterly profit. Let that sink in. Operating profit up 1,900% year over year, and the stock crashed. That's not a typo. That's the story. And it's exactly why we need to talk about what's happening to AI stocks right now. This video is about the AI stock crash that's rattling investors in the summer of 2026. But I'm not here to just throw numbers at you. I want to explain the paradox. Why are AI stocks tumbling at the exact moment the underlying business is printing money? Because if you understand that, you'll understand not just this sell-off, but every bubble, every hype cycle, and every painful correction that ever came before it. And by the end, you'll have a clear framework for what comes next. If you find that useful, hit subscribe. Let's get into it. The first thing to understand is that this wasn't a random crash. It was a textbook case of what happens when the market's expectations detach from reality, even when reality itself is extraordinary. Monday's sell-off started with Samsung. The company reported preliminary guidance for its second quarter, and the numbers were staggering. We're talking about $58 billion in operating profit, nearly 19 times higher than the same quarter a year ago. The reason? Explosive demand for high-bandwidth memory, or HBM, the ultra-fast chips that sit next to AI accelerators like nvidia's GPUs. Without HBM, the AI infrastructure boom doesn't work. Samsung, along with SK Hynix and Micron, has been selling every single chip it can make, and prices have soared. This is the kind of earnings report that, in any normal world, would send a stock soaring. Instead, Samsung shares cratered. Why? Because the market had already priced in something even better. Look at the chart of Samsung's stock over the last 18 months. It nearly doubled. It wasn't just Samsung, the entire memory sector had been on a tear, driven by the AI narrative. So when the actual news hit a 19-fold profit jump, beating expectations, it wasn't enough. Investors had already bought the rumor. Now they sold the news. The sell-off rippled instantly. Micron dropped. SK Hynix dropped. Then it spread to the broader chip space and then to the Nasdaq. The SOX index fell 4.7%, its worst day in months. And here's the key. This wasn't about bad news. It was about the absence of unimaginable news. The bar had been set at perfect, and perfection wasn't perfect enough. That's the proximate cause. But the deeper reason this crash happened is something every investor needs to understand. The AI stock trade had become the most crowded, most expensive, most consensus bet in the market. Over the past 2 years, a handful of stocks, let's call them the AI Big 10, had swollen to dominate the major indices. Nvidia, the poster child, had created trillions in market cap, but by 2026, it's been essentially flat for the year. At one point, from its May peak, Nvidia shed nearly $1 trillion in market value. $1 trillion vanished, not because the company is in trouble, its chips are still the backbone of AI, but because the stock had simply run too far, too fast, and the valuation had become a bet on a future so bright that any cloud looks like a storm. And that's where the real tension lies. The massive disconnect between the speed of AI infrastructure spending and the speed of real-world AI adoption that generates revenue. The hyperscalers Microsoft, Amazon, Google, Meta have committed hundreds of billions to build out data centers packed with GPUs and memory. That spending is real. It's why Samsung's profits are exploding. But the question that has been nagging the market for months, the question that finally started to trigger selling is, when does that investment actually pay off? When do we see productivity gains, new revenue streams, killer applications that justify the trillions in capex? Right now, the spending is running way ahead of the proof. And in a market where interest rates are still high and the Fed is talking about tightening again, the patience for "trust us, it's coming" is wearing thin. Hedge funds have been selling tech hardware for 4 straight weeks leading into earnings season. That's not speculation. That's a real shift in positioning. The smart money was already rotating out before the Samsung news hit. Now add to that the classic ingredients of a crowded trade: algorithmic selling, technical breakdowns, and the sheer mechanical pressure of too many people holding the same thing. When the tide turns, the exits are narrow. On July 7th, the selling fed on itself. It wasn't just profit-taking, it was a mini capitulation. One analyst note I saw put it bluntly: even the strongest AI demand story can't fight valuation gravity when positioning is this extreme. And that's exactly what happened. The sector had become a monument to high expectations. Samsung's record profit was the trigger, but the explosives were already in place. So is this the end of the AI boom? Is it a dot-com style bust? I don't think so, and here's why. The underlying demand for AI compute is not fake. It's not a theoretical concept. Memory chips are literally sold out for the next year. NVIDIA's next-generation platform, Vera Rubin, is on the horizon, and the pipeline is full. The build-out is a multi-year supercycle, but the market is a forward-looking beast. It prices in the future, and right now it's pricing the probability that the future might not be as flawless as the previous prices implied. This correction is actually healthy. It's shaking out the froth, the leverage, the momentum chasers who bought at any price. For the first time in a while, Nvidia's forward multiple actually looks reasonable to some value-conscious investors. That doesn't mean the bottom is in, but it does mean the risk-reward is shifting. The big question for the next few weeks is earnings season. We're about to hear from Nvidia, from the hyperscalers, from the entire AI food chain. If their guidance is strong, if they can show that the orders are still accelerating, that the cloud providers are still desperate for capacity, then this crash could be a sharp but short-lived reset. The headlines will flip from AI stocks crash to AI stocks roar back on blowout earnings. But if the commentary is more cautious, if there's even a whisper of capex digestion or inventory build, then the pain could extend. The market is now on high alert for any sign that the AI investment cycle is maturing faster than expected. There's also a geopolitical wildcard. Recently, we heard reports that some Chinese firms are developing alternatives to the high-end chips they can't easily buy. And there were scattered stories about capacity adjustments at Meta. None of these alone are enough to derail the thesis, but together they add to the narrative that the AI supply chain might not be as tight forever. When you're priced for a permanent shortage, any hint of future supply and demand balance is a risk. So what's the takeaway here? The AI stock crash of July 2026 is not a sign that AI is over. It's a sign that the market got ahead of itself. It's a reminder that even the most transformative technology in history can have brutal, gut-wrenching drawdowns. The stocks that go up the most are the ones that fall the hardest when the music stops. And the music always stops, at least for a beat, when the expectations can no longer keep up with the hype. The paradox of Samsung's 19-fold profit jump and its crashing stock is the perfect illustration. In the market, it's not about how good the numbers are. It's about how good they are relative to what was already baked in. And currently, the oven was set to 500 degrees. Going forward, AI investing will likely be less about buying the whole basket and more about picking the winners that can convert spending into earnings. The easy money, the everything goes up phase is probably behind us. And that's actually a good thing for the long-term health of the sector. It brings back some discipline, some focus on fundamentals. The companies with real pricing power, real moats, and real paths to ROI will separate themselves. The rest will be exposed. If you're watching this, you're probably not a day trader trying to time the bottom. You're someone who wants to understand the forces shaping this market. So here's the final insight. Corrections like this are not accidents. They're features of how markets price uncertainty. The AI story is still being written. The demand is real. The chips are real. The profits are real. But the stock prices? They're a function of human emotion, and right now, fear is doing a lot of the work. That's why we're crashing. The question is whether you believe the fear will look as overblown a year from now as the euphoria did a month ago. Thanks for watching. If you want more deep dives on the intersection of tech and money, hit that subscribe button and check out the video on your screen now. I'll see you in the next one.